So my name is Luke Lang. I'm one of the co-founders of Crowdcube, which is the UK's leading equity crowdfunding website. Crowdcube started back in 2011. At the time we were the first, not just here in the UK or in Europe, but anywhere in the world, to be taking the Kickstarter model, reward-based crowdfunding, and applying it to businesses. So the idea was to give investors the opportunity to invest and get real shares and real equity in those businesses, really trying to make investing accessible, affordable and rewarding for all. And on the flip side, giving entrepreneurs the opportunity to access capital that previously was rather difficult to come by. I think the difference between equity and reward is really quite stark. Yeah, I guess from a reward point of view, it's really quite limiting. You know, the businesses have to have a product that they can offer up as a reward or a download, and they need to already have an existing community that they're able to tap into, and they very much rely on the idea going viral and getting out there and getting some head of steam and momentum. The difference with equity crowdfunding and Crowdcube is obviously that we bring a huge community of investors. We've got 175,000 people registered on the platform that are all looking for great investment opportunities. So you've got that capital there that's waiting to be invested. And of course it applies to a much broader variety of different business types, whether it be retail shops or tech businesses looking to scale up, restaurant chains, food and drink companies. So it's got much more broad appeal than the Kickstarter model. And of course, people can raise much larger sums of money on average. A reward-based platform, you're looking at the average is probably a few thousand, although there are some notable examples that have raised tens of millions. But with Crowdcube, the average is around £500,000, and we've raised up close to £4 million for businesses. The reason why you're starting to get more businesses like Chirp and like Sugru turning towards crowdfunding now is I think people's perceptions of crowdfunding has changed dramatically over the past 12 to 18 months. People are now choosing it as their primary option, and the stage and the growth stage of the businesses has changed as well. So it's, you know, often crowdfunding is positioned much more for startup seed stage finance, and we're actually starting to see a lot more mature businesses, not just with an entrepreneur but with an executive team, often a team that's been running businesses in the past, high profile businesses that are looking to raise finance, and in many cases they're well backed. We've got a couple of businesses on the site at the moment that are VC backed. One of them has got the ex-COO of Zoopla on the site, and an ex-executive from eBay. So really strong teams, seasoned entrepreneurs that have been there, done it. And I think that's helping to change people's perception. So you're starting to see, not just in kind of the maker kind of demographic, but right across the board in terms of the different types and stage of businesses that are coming to Crowdcube. And if you're looking to compare crowdfunding, equity crowdfunding for businesses, the UK and US, the stark difference is obviously the regulatory environment. It's prohibitive over in the US, whereas the UK, the FCA, has been much more flexible in their approach and actually kind of nurtured the industry, certainly in the early days, and has introduced bespoke regulations for the industry, which has really helped it to mature and develop and build a strong reputation. In terms of available capital, I think the UK has always lagged behind the US in terms of equity finance. I think pre-Crowdcube, businesses turning to equity rather than debt was around about kind of 3 to 5%, whereas in the US it was 18 to 20%. So there's a much stronger culture in the US of raising equity finance rather than going to debt. And I think in the UK, historically businesses, the culture is much more you turn to the bank to raise finance. And I think with the advent of crowdfunding, that culture is certainly starting to change. The fact that we've got 170,000 registered investors, many of them investing for the first time, shows that there's a real appetite for ordinary people, ordinary everyday investors to back and support British businesses. And I think you're now starting to see venture capital world starting to really embrace it. Certainly much more progressive VCs. You know, we've worked with Index Ventures. We've obviously worked with Boulderton Capital that have invested in us personally. Passion Capital is investing in a business on the site at the moment through the platform. So I think you're starting to see a blurring of the lines between what is kind of friends and family, what is crowd, what is angel, what is VC, and in the future, I think you'll start to see institutional money start to play a key role. The regulatory framework in the US is much tougher than in the UK, and it is really difficult to predict how that's going to unfold. You know, the Jobs Act has been going through its various stages of progression for almost as long as Crowdcube has existed, you know, three years or so. So, and it's obviously that development has been a lot slower than a lot of people would have liked. I think the presidential elections that are coming up in the next 12 to 18 months might actually slow things down a lot further as you know, either side doesn't want to actually introduce regulations at that kind of critical stage, and they don't want to introduce something that's just going to get unwound again in 12 months' time. So I really do empathise with startup early stage businesses in the US, because I'm sure that they're looking across to the UK in particular, but also Europe and the rest of the world with a lot of envy, a great deal of envy, with what we've achieved in a relatively short period of time. And I'm sure that if the SEC were to embrace crowdfunding and really try and nurture it, then the US market could simply be huge. I don't believe that the prospect of failure, businesses failing in equity crowdfunding is going to massively hurt the industry, because that's kind of built into equity finance, it's built into equity investment. We're very, very open and honest and transparent with all of the investors about what the risks are. You know, if you want to invest on Crowdcube and you're a first-time investor, then you have to do a risk assessment before you can even see a pitch, let alone invest in it. And those questions, that multiple choice questions, is rather blunt. You know, the first question is, what happens to most startups? The answer is they fail. If you get that wrong, you don't get to progress. So I think people go into this with their eyes open. They know that they're long-term investments. They know that they're highly risky. They know that they're unlikely to get any dividend payments. And they should be diversifying. So I think with the way that we've built and structured the industry and worked with the FCA to introduce appropriate regulations and investor categorisation, I think that's going to insulate us from major failures. Having said that, there are lots and lots of equity crowdfunding platforms that are popping up all of the time, and that would be a concern to me, is that a new crowdfunding platform that may not do anything deliberately, but they may not necessarily understand the rules and regulations as acutely as we do, that may make some mistakes that then cast a shadow across the industry. But we work very, very hard. We set up the UK Crowdfunding Association, and we're working very hard with all of the people in the industry to try and make sure that doesn't happen. So what would my advice be to an entrepreneur looking to choose between either rewards, equity, or more traditional routes rather than crowdfunding? I guess you need to look at the business and look at the aspirations of the business and look whether it's appropriate for reward-based crowdfunding. Most of the businesses that we fund wouldn't be appropriate for Kickstarter or for Crowdfunder here in the UK. They simply don't have the products or the downloads or the services that would generate enough interest and enough investment or enough donations for them to be able to raise the kind of money that they're looking for. And I think if you're looking at a more serious business that's looking to raise a significant chunk of capital, in the hundreds of thousands of pounds, then offering a share of equity and a stake in the business and potential upside further down the line, rather than just a T-shirt as a result of a Kickstarter campaign, is probably more suitable for the types of businesses that we're looking to attract. The sort of great ideas clearly addressable markets that they think that they can attack and scale into, and really strong teams. Now, don't get me wrong, we've actually had businesses that have raised money on Crowdfunder, which is a UK crowdfunding platform, and they raised 10, 20, 30,000 pounds on Crowdfunder, and then they come onto Crowdcube and raise north of 100,000 pounds. So there is a progression that you can do there, and we're looking to work with Crowdfunder to try and identify more cases like that. Certainly for businesses that are looking at the more traditional ways of raising finance, that are going down the angel route. Many businesses come to us with angels already lined up, or already wanting to invest in the business. That's pretty common. You would expect that from a savvy entrepreneur. They've done the rounds, they've spoken to their network, they've spoken to their wealthy friends and families, family members. But they recognise the benefits of doing a Crowdcube campaign as well. They recognise that if they've got £100,000 from a couple of angels, they can use that as a really good springboard to go on and raise £200,000, £300,000. That validation that you get from an angel can really help a crowd campaign. So I don't think that any of them are mutually exclusive, really. And of course, from Crowdcube's perspective, you can actually, as well as offering equity, you can also offer rewards as well. So that's a common practice that we have. And those rewards are not really designed to be the main driver and the main motive for people to invest, but they are a mechanism that allows investors to get a return much quicker, so they can get something back. They can get that sense that they're part of the business and they're involved in the journey much earlier on, rather than waiting for 3, 5, 6 years before they get that huge return on the investment that everyone is looking for.